What is the main reason institutional investors give you for not adopting crypto?
So the
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bring that money back, and just building it, building it, and building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
August jobs were right on target.
Pretty much in line with what Wall Street expected.
A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, Friday on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacqua here in London. Now, the Tesla boss, Elon Musk, under fire for a series of tweets calling for Ukraine to seek appeasement with Russia to end the war. Now, the SpaceX founder and chief executive also called on Kyiv to give up Crimea for good. Now, for more on all of this, we're joined by our card star, Craig Trudell. So, Craig, this is not really about Ukraine and, what should happen. This is about Elon Musk, who feels he can tweet about everything and anything. And actually, Tesla shares are up 2% in pre-market. Does this hurt his business or does it help his business?
I think it's hard to say. It's certainly the case that people have kind of looked the other way or put up with his antics, going back many years, right? And we've republished a story from just a couple of months ago this morning about this idea that would-be buyers or customers of Tesla are sort of turned off by Musk. And I think we've seen more of that just in the last maybe say 6 months when his politics have kind of changed.
What was the quote of the day? I mean, there's a brilliant quote in this article.
Yeah, there's one of the consumer surveys that we cite in the story. Talks about this idea that it refers to this idea that the sort of worst attribute of the Tesla brand among a lot of those surveyed people cited Elon Musk. And one of the people who conducted this survey talked about this idea that some consumers did tell them him, I love my car, but I really wish I didn't have to defend my choice of car, because of the latest Elon Musk tweet, something to that effect.
But at the same time, he's a little bit enigmatic because he's also sent Starlink to Ukraine, so you don't really always know on what side of the fence he sits on.
Totally. I think he's tried to have it both ways here. It was really within a matter of days, maybe weeks after the initial invasion, that he stepped up and sent Starlink terminals. He even sent generators and other products to Ukraine, engaged with officials in Ukraine about the thank yous and your welcomes for sending this your way. At the same time, he's also talked about, he's joked about people on Twitter supporting the current thing and talked about woke mind virus. So he wants to kind of chide people for blindly supporting Ukraine, and yet at the same time, he's very clearly inserted himself into this even before yesterday when he started doing this tweeting.
Many people won't know who the Volkswagen chief executive is. Is that not, though, any bad publicity, even bad publicity is good publicity kind of scenario?
That seems to be his bet. I mean, he clearly likes to be in the news. He likes to be, trending on Reddit, trending on Twitter, and there's really sort of no controversy that he shies away from, making himself a part of.
That's a very diplomatic way of putting it. Craig, thank you so much, Craig Trudell. An Elon Musk watcher. Now, a rallying global market seems to be extending into a second day, lifting also U.S. indices or futures and European stocks. Investors wagering that central banks may slow the pace of monetary tightening. Coming up, we speak to the French finance minister, Bruno Le Maire. That's as ministers gather in Luxembourg to discuss the energy crisis. That interview up next, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So this is a whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Turning down the heat, U.S. manufacturing data comes in soft, easing bets on Fed tightening. The RBA hikes half as much as expected, bashing yields and the Aussie dollar. Seeking calm, UK Chancellor Kwasi Kwarteng is set to bring forward his fiscal plan, looking to reassure markets after a pretty embarrassing U-turn. Plus, crisis of confidence. Credit Suisse shares jump, despite investors' uncertainty over how the bank will actually pay for its restructuring. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, European finance ministers meet for a second day in Luxembourg, with energy taking center stage. That's as they consider ways to tackle the crisis since Russia began cutting gas supplies. Let's head over to Luxembourg, where Maria Tadeo is standing by with the French finance minister. Maria, over to you.
Thank you, Francine. Good morning. And we're joined exclusively on Bloomberg TV by the French Finance Minister, Bruno Le Maire. Thank you so much for joining us today. This is a Eurogroup that has been, well, hectic, but also very interesting. And you can see there's some tensions building behind the scenes. But before we get into that, I want to get your outlook on the European economy, because the idea was recession is almost inevitable. But it seems to me the story is way more complex, but also more nuanced when you look at storage, when you look at demand destruction. So overall, how do you see things?
I remain pretty optimistic, even if, of course, we are facing difficult times. We have an unprecedented level of inflation since the creation of euro, which raises a lot of concern among our citizens, among private companies. But I will give you my strong belief. If we remain united, all the 27 member states, we will overcome those difficulties by mid-2023. I would say the key point is to stand united. And that's why I really think that there is a need for a global action plan at the European level against inflation.
And can I ask you, you talk about solidarity, and well, I think I've heard you speak now in 24 hours 3 times, and it's a word that comes often in your speeches. When you say solidarity, when you say unity, is that a message to Germany? And what does a level playing field mean when you have 200 billion euros to spend?
It's a global message to all the member states. And solidarity is part of this European action plan that we are proposing against inflation. The first point is energy efficiency. We need more energy efficiency, which means that we need to reduce our energy consumption. And I really think that we must do better as far as the reduction of energy consumption is concerned. The second point, as you just said, is solidarity. I think that we could think about a proposal like the SURE mechanism that proved to be very efficient during the COVID crisis. We could have the same kind of mechanism against the consequences of inflation for the countries that are mostly hit by the consequences of high prices. I'm not talking, to be very blunt, about common debt issuance. I'm talking about a SURE mechanism, which means the possibility of raising money at the national level, but with the guarantee of all European member states. This would be the second point of this global action plan. And the third point is to have targeted measures, targeted support to private companies that are exposed to the international competition and that are paying too much for their energy.
So you come here with a plan. Based on everything that you said, essentially there's a
global French plan we have been discussing with the French president based on solidarity, a kind of SURE mechanism, targeted support to the private companies that are facing these high prices and that cannot support this, cannot face these very high energy prices, and of course the necessity of reducing our energy consumption.
But you're saying I'm not calling for a recovery fund, and that's important to clarify.
I'm not talking about common debt issuance or a recovery fund or something like that, because we know that it might raise some difficulty among member states, and there is a need to decide quickly. I'm not talking about an action plan on which we should discuss over the next month, over the next weeks. We must decide now, because inflation is hitting our economies, our citizens, our private companies, our industry right now. So there is a necessity for deciding in the coming days, not in the coming weeks.
And of course, President Macron met with Scholz yesterday, and they will meet again later in the week. But in your conversation with Christian Lindner, I spoke to him in the morning. He said, I don't see the need for more debt. I don't see the need of this big plan. We have what it takes for the time being. So essentially, you disagree.
That's exactly what I'm not talking about, common debt issuance. I'm just talking about the possibility at the national level to raise debt, but with the support and the guarantee of all European member states, which means that you could borrow money at the lowest price. And that's a key point for many member states. But of course, I've been talking with Christian Lindner yesterday. We are working very closely together, like President Macron did yesterday with Chancellor Olaf Scholz.
And can I ask you, that's on the European level where you make your points very clear, you have a plan, and you
I made this point very clearly yesterday, explaining that we should not underestimate not only the financial, not only the economic, but also the political consequences of inflation. We should never forget what happened in Europe when we had a very high level of inflation. Once again, this is an unprecedented level of inflation since the creation of euro. There is a necessity to decide. There is a necessity to have a global action plan and an economic response which is not limited to one single decision or one single action from every member state, but which is based on a global framework on which I'm deeply convinced that we can find a compromise and an agreement.
And of course, a lot of this is back to energy, and one of the components here has been nuclear. And nuclear for France was everything. It was about the sovereignty of the country. EDF, this is an emblem of Made in France, but when you look at the fleet, half of it is not working. Electricity production is not really working for the French either. You're paying a lot of money for this. You have new management coming in. You know the criticism that this company has been very badly managed. Is it going to change? Are we going to see a turnaround at EDF?
It's going to change because we have a new management for EDF, and of course the first mission of the new management of EDF, Luc Rémont will be at the head of EDF, is to have those 12 nuclear plants being reopened as soon as possible. I mean, by the beginning of 2023, we want all these 12 nuclear plants being reopened because there is a need for nuclear plants and there is a need for nuclear electricity. If you want to face the necessity of fighting against climate change and having those radical changes in the way we are reducing CO2 emissions, there is a need for nuclear energy. And I really think that the mix of nuclear energy and renewable energies that has been proposed by President Macron is the right strategy for France and might be the right strategy for many member states.
Maybe that's a hint to Germany, which is of course debating what to do with nuclear. But going back to France, of course you mentioned now your country, you put out your budget. You know some of the reaction to it. Perhaps it's too optimistic. You say you don't want to talk down your economy. How do you defend a budget in such a complex scenario where you're still more optimistic than the average? I mean, the numbers speak for themselves.
I'm just defending my budget looking at the current situation in France. The level of growth in 2022 should be 2.7. There was many observers explaining that we would never reach 2.3 or 2.4. We have 2.7% of growth in 2022. We are creating jobs. The level of investment of private companies remained pretty high. So that's why I'm so much optimistic, so much determined to provide growth to France for 2023.
So you say the naysayers will get it wrong. But just as a final question, because this also feeds into this budget and fiscal responsibility, the pension reform. I'm sure you knew this was coming. It's a perennial issue for the French government. There's many out there who say the window is just closer and narrower, and you're not going to do this as you hike energy bills. So you have 2 months to get it done. Will this pension reform happen? Will it go through this year?
Yes.
Yes, clear answer.
Yes, my response is yes. The pension reform will enter into force next summer 2023. We have been promising this very important reform during the presidential campaign, and we will stick to our promise.
Well, and of course, we'll speak, if it goes through again, I'm sure, to talk about whether or not it actually does improve the fiscal finances of France. Well, Mr. Le Maire, thank you so much for joining us on Bloomberg. Always good to see you. And Francine, that was the French Finance Minister, Bruno Le Maire, joining us here as this Eurogroup continues on day 2. And you can see there's a lot to talk about in this one.
There is a lot, and a lot of times, great interview, Marie, a lot of times we look at it, of course, through the markets lens, but Mr. Le Maire, they're saying very clearly it has huge political implications. Actually, if you see higher inflation, it could really break governments and change election results. Maria Tadeo in Luxembourg for us. Now, coming up, the tax cuts may be gone, but the vast majority of Liz Truss's economic project remains. We'll get the city's perspective on the plans. That's coming up next, and this is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Australia's central bank has surprised investors by raising rates at half the pace expected, sending the Aussie dollar and bond yields tumbling. The RBA ended a streak of half percentage point hikes, opting instead to raise the cash rate by 25 basis points to 2.6%. Only a quarter of economists polled by Bloomberg did predict the move. Now the judge in the Theranos fraud case has decided to delay the sentencing of former CEO Elizabeth Holmes. He wants to review the testimony of a key witness for the government, former Theranos lab director Adam Rosendorff. Holmes has argued she deserves a new trial after Rosendorff allegedly showed up at a home in August trying to speak with her about his testimony. Bloomberg has learned that the Biden administration is planning to announce new restrictions on China's access to US semiconductor technology. Sources say the Commerce Department will roll out a package of rules this week to govern which semiconductor technologies can be exported to China. Under current guidelines, US chipmakers can sell machinery for use in China under certain circumstances. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, the UK government has, for now, abandoned its plan to cut the highest rate of income tax. But that policy only a small part of the so-called new economic deal that Prime Minister Liz Truss wants to set in motion. Now, to get the city's perspective on this plan, we're joined by Mark Austin. He's partner at Freshfields, also helped write a paper on what regulation is needed to kickstart the IPO market here in the UK and London. So, Mark, thank you so much. We did a wonderful podcast together, actually, about a month and a half ago, and we were talking about why Amsterdam, in certain cases, is doing so much better than London. And since we had proposals from the government, where are we now in terms of attracting IPOs and getting things through the pipeline?
Well, I think there's a really good conversation going on, actually. And actually, the whole sort of policy direction, stated policy direction of this government has been very helpful. The new music around actually needing to do things a bit differently, actually encourage growth and be bold and brave where perhaps we haven't been before, challenge some orthodoxies, I think is something that the city generally is leaning into and thinks is a good thing to embrace.
But not the smart money. This is the problem, is that they maybe went too far in some of the policies, and does it mean that they'll have to roll out some of the anti-regulation rhetoric that was for the City of London, not for the tax cuts for the elite?
I don't think so. I mean, I think the deregulation sort of mood music, I think, is helpful, because I think that's the tenor of the city at the moment. I mean, across the top, things like tax cuts, etc., that's a sort of political point. Bankers' bonuses is a more political point. But there are lots of effectively non-political points that sit underneath that, because whether you're left-wing, right-wing, centrist, actually the future success of the City of London, given its contribution to the UK economy, tax take, jobs, general economic growth, is a no-brainer. And so actually, the reform conversations that are taking place in the city at the moment, I think everyone's quite heartened by the direction of travel of this administration.
I mean, it's a no-brainer unless it's consumers that pay the price. So there's also talk about regulators coming up with rules and then ministers being able to supersede them or to say, actually, no, we'll do it this way. Is it consumers and the common man and women that can pay the price for that?
I don't think so if we get it right. I mean, the FCA, for example, has a statutory objective of consumer protection. And clearly, given the macroeconomic and geopolitical environment at the moment, consumer protection is a key tenet of everything we need to do. So we need to reform, keep the city relevant, but also make sure we have appropriate protection. But the key is, what the real thing in the question in that is, how do you get that balance right? And actually, there's probably a discussion to be had around in the capital markets in London. Perhaps that balance should be slightly more nuanced than it is in some other areas. For example, you and I as mortgage holders and interest rates, etc. But actually, my mother in Yorkshire, thinking about investing in an investment product, perhaps the balance should be slightly more weighted towards risk taking in the capital markets. which I think is something in London that we've slightly lost in recent years.
What do you think that the concern is now? So you were telling me that Amsterdam, for example, is much more nimble in pitching for some of this stuff, so they're attracting, of course, business. But because of the U-turn, which is different to what we're talking about, so this is not for the city, but because of the U-turn, do investors kind of think, well, I'm not sure what's going on in the UK right now?
I think there is a little bit of a question around that, yes, around the investability of the UK. But that is a perception point as much as anything. And actually, a lot of the conversations that are happening now are seeking not just to reform the blacklist law, blacklist regulation, which is what my review is about, it's what Hill was about, it's about what also the other reviews were about. It's actually about changing the narrative in the UK, changing the perception of the UK, and making it clear that we are a insurgent, fleet of foot, appropriately protected, well-regulated environment that nevertheless offers the best place for companies to come and list.
So where do you think we'll be in that review? I think some things are going to Parliament. We have a new city minister.
The city minister has a lot of energy. He's great. I mean, he's been going around talking to everybody, and he's very embracing of this drive. And I think that that whole reform agenda is going to move forward with some speed. And there's a lot of people in the city who are feeding ideas to that, thinking actually about what can we, given the welter of stuff that's going on at the moment, the danger actually is there are so many conversations that they all get lost or that they cross over each other. And so actually part of the art at the moment is working out what are the things that we can do in the shorter term that have the maximum impact for the city as a whole.
And would this be actually reversing, I guess, maybe some of the talent loss after Brexit, or this is a new set of rules?
No, so it's reversing some of the talent loss, but it's actually not new sets of rules. It's actually, I think, refining sets of rules and actually working out. London for the last 20, 30 years has built up an architecture that it could bear when it was necessarily the default, in most cases, the default financial centre, default listing venue in Europe. It's not necessarily that anymore, as we discussed before. And actually, the conversation is about, in order to keep London relevant on the global stage for the next 20, 30 years, what do we need to do in terms of being more nuanced and thoughtful about our rules, more principles-based in how we reform, rather than actually necessarily tying companies up and investors up in black letter?
I think there are like 15 or 20 points of what we should do. What do you think will get done in the next 12 months?
Well, what do I think will get done in the next 12 months? I think that we will see regulatory reform completed, so that by end of Q2, Q3 next year, we'll have a regulatory system that's more or less bears comparison with any other listing jurisdiction in the world. That will happen. I think we will see some further conversations around investor attitudes in London. I think we'll see some further conversations around pension investment, greater DC pension investment in markets. I think we'll see some more conversations about tax breaks, joining up across public and private capital markets in terms of the tax system that we have. I think there's lots of quite sort of, I hate the phrase, but sort of easy wins that can happen in terms of actually just changing the narrative of it.
Are you still speaking to the government now, or are they distracted by everything that's going on?
No, they're fully engaged. They are fully engaged.
And do you think we could see something in the next, even couple of months? Is it something that could be done before the end of the year?
I mean, there's a lot of conversations going on. It's not for me to say when they will come forward with any proposals, but there is a lot of activity and a lot of very good conversations happening.
All right, Mark, thank you so much. Mark Gosselin, their partner, Freshfields, of course, also one of the main authors of this review, and a good way of looking at the City of London. So we'll get him back on to bring you all of the very latest on that. Now, coming up, we'll be looking at the top market moves this morning as a global rally continues. This has to do also with some weak data we had in the U.S. The stocks, bonds rallying, the market now pricing in a peak rate waiver, which is lifting off a lot of these markets. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now let's take a look at how the markets are moving after a global rally extended into a second day, lifting U.S. indices, futures, and European stocks. Well, joining us now is JP Barnett. JP, what's driving the bounce?
Well, yesterday we had some weak economic data out of the U.S., which sounds counterintuitive. But the market took this as a sign that the economy is cooling, that this maybe creates a pivot point for Fed policy and for the rates to go down. So it's actually a positive thing. But when I read about it, I still thought it's a bit of a silly reason to belong in risk assets here. But it shows you the sentiment was so bearish, and everybody was kind of keen to buy the dip and was just waiting for a good argument to do so. And now it was a data point that they picked, and we see a nice little rally there.
So, JP, can it last? And if not, what is needed for it to do so?
Well, that's still the big question. I'm a little bit cautious if it really can last. We have bearish positioning, as I said, and that can drive some rallies over a couple of days or even weeks that we have seen during the summer. But to really endure that rally and to bring a change in sentiment, more importantly, I think we need more data points. We need actually probably some hints from the central banks that they are nearing a point where they are willing to at least ease down on the rate hiking. We want to see inflation coming down. Let's not forget, estimates are still for a brutal move lower in inflation next year. So if those estimates start to be believed, then we could see the rally going a bit longer.
JP, what's your take on Credit Suisse right now? The hot take?
Well, a hot take is the bank is really borderline right now. It's in danger of fully losing the trust of its investors. It needs to make a bold announcement now, not exactly a fast one, but one that has substance, that has a real strategy behind it, and that can reassure the trust in the bank to be profitable in the long term. Because otherwise, there will be in a vicious cycle of losing trust, higher cost of capital, losing clients, losing profitability, and this will go on and on and on. So a bold statement here is needed at the end of the month or earlier.
Great. Thanks so much, JP Barnett there with the very latest on some of these moves. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kayleigh Lyons are in New York, Anna Edwards here in London. Now, the focus, not only what we heard from the RBA, but of course, peak expectations for hikes at the Fed. A couple of other things we need to watch out for. A great Kenny Donaldson story saying that Liz Truss will struggle to drive through key parts of the economic revolution she's planning for the UK because her standing in the ruling party is already so damaged. We'll also cross over to Birmingham with our Lizzie Burton. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball, so their apps will surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We are starting to see some companies rip off the earnings mandate.
It's really, I think, important to be forward-looking.
I'm not sure what's normal in today's environment.
We are growing a little bit more nervous about that consensus trade.
It is kind of a bearish opera, and the conclusion is that the opera ain't over until the Fed lady sings a more optimistic tune.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kayleigh Lyons.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Shock down under. A smaller than expected rate hike from the RBA fuels the debate over whether the end of tightening could possibly be near. Top EU officials raise the possibility of joint debt to tackle the energy crisis, but more hawkish members of the bloc are strongly opposed. We're live in Luxembourg as ministers meet. And Credit Suisse's options go from bad to worse. Investors want to know how the bank will pay for a major restructuring. Welcome to Bloomberg Surveillance Daily Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, it seems that bad news yesterday on the US markets, on Wall Street, manufacturing in particular in the US. Bad news seems to be good news for risk assets once again.
Yeah, it does. It feeds into the narrative that if the data turns, then central banks won't be quite as hawkish. And the market kind of got confirmation of that from the RBA in Australia overnight, delivering a hike of just 25 basis points, so ending their streak of outsized rate hikes. And that had an impact across asset classes. Of course, you still had China and Hong Kong closed for holidays, but stocks up 3% in Japan, and then Australia up 3.25%, the best day for Australian stocks going all the way back to June of 2020. Where the real impact was, though, was in the bond market. That two-year yield in Australia coming in nearly 32 basis points just in a single day, down to the 314 level. And interestingly, the Aussie dollar was stronger against the US dollar, given that the US dollar seems to be weaker against mostly everything. But as you've seen, less hawkishness on the central bank front. There's a weaker Aussie dollar against the US dollar this morning by about 0.2%, trading around the 65-cent level. So one central bank has kind of pulled back the gas pedal, Matt. The question is when all the rest are going to follow.
Yeah, one down, everybody else to go. Nonetheless, market participants are bullish. At least futures are trading higher. After the cash trade rose up yesterday, we're looking at a 1.5% gain again in futures. We still have 4.5 hours to the open, but that's a very strong reading for this time. Right now, 10-year yield coming down, so that does mean that investors are buying treasuries. Ray Dalio says cash is no longer trash, and I think that extends probably to the treasuries world, maybe not out to 10 years, but certainly earlier on the curve. Right now, 357.95 is what you see on the benchmark treasury. And then gold right now, up another 0.5% at 1709 after really a huge rally. I think it was up 2.4% yesterday, which doesn't sound like a lot, but it is a massive rally for gold. Back up over $1,700 at 1709. The Bloomberg Dollar Index is coming down, and you can see that in Bitcoin as well, although it still has yet to pierce the $20,000 mark again. Right now, up 1 2/3%, 19,913. We're going to be watching this very closely because Kaylee and I have a crypto show today at 1 p.m. this afternoon.
Absolutely. So Crypto in Focus, and no doubt for that reason, Matt, this show should be provided with shades, such as the brightness of the green. For our radio audience, I'll just fill you in that we've got green across the board for European stocks today, up by more than 2% on a number of major markets in Europe. This is a bit yesterday's story because we're following on from what happened on Wall Street yesterday with worse than expected manufacturing data, sort of reigniting that talk about a Fed pivot. So that is part of the story, but it is also pricing in, as Kaylee says, the narrative from the RBA, one central bank down, others could follow. Is this premature? We will see, but market's certainly running with this story for now. Let us have a look at a deeper dive into other European assets, and this is what we have on the UK two-year. The two-year yield once again coming down. We're seeing buying of debt products across the curve, but in particular at the short end in the UK. But this is actually part of a global story more than just what's going on in the UK today. The natural gas price for Europe down by 2.3%. It was actually down by quite a lot more than that earlier on, and that really because of some pretty mild, very lovely weather that we're having in parts of Europe today, and as a result reduces worries at the margin about the winter and gas storage levels. Credit Suisse up by 5.8%. We put this in again today because of the big moves we saw yesterday and then the recovery in the stocks. It was down as much as 12% in session yesterday. Those CDS, the cost of insuring against default, went to a record high, and then we saw those losses in the share price paired, and this was all on the first day of the new CFO at Credit Suisse. So a busy time and a lot to get stuck into, no doubt, over at Credit Suisse. More on that story shortly. Dragscoop, this is interesting. This company is an energy-generating business here in the UK. It was down yesterday in anticipation of some negative media coverage around its environmental record. The company's pushed back strongly against that. But actually, today's sell-off is all about whether we will see another U-turn, Matt, from the UK government. They U-turned on the top rate of tax. Will they U-turn on their declaration that they wouldn't put windfall taxes on power-generating businesses, Matt?
Right. Everyone seems to be pushing even harder after they got that first U-turn. Let's get to the RBA's pivot right now. A dovish surprise, it's being called. Australia's central bank ended a streak of 0.5 percentage point hikes, opting instead to raise the cash rate by only 0.25%, 25 basis points to 2.6% in total. Only a quarter of economists that we polled predicted that move. Andrew Ticehurst, a rate strategist at Nomura, says the RBA is clearly dancing to its own tune. So is this a sign that peak rates are near? Let's get more at Bloomberg's Danny Berger. Danny?
I love that idea. Is this just the RBA out on its own? Well, certainly not what the market has interpreted because of the impact across global bond markets. But let me first put the size and scope on the Aussie bond move itself. Three-year yields plunged, the biggest intraday fall since 2008. So that just shows you what a surprise this was to this market, but not just a surprise. It is a market where we've just seen carnage to global credit. So it really is a lot of bad news priced in. Any sign of sort of a soft pivot narrative seems to send bonds higher, as we saw yesterday with weaker manufacturing data. So it wasn't just Aussie front-end yields. It was across the globe, from the UK to the US. We really saw this big plunge in bond yields. Even Germany down 13 basis points for the two-year yield. Again, it is a market, whether it is the economic picture worsening or financial instability that they're hoping will make central banks pivot. This is what the market is pricing. But again, the market is pricing something different than what Fed officials are saying. We heard from Barkin yesterday saying that they need to continue to hike, that this environment is different. Williams saying that they're not yet in restrictive territory. They need to keep going. Even so, we've priced out about 80 basis points of hikes for year-end next year. So what the market is doing and what the Fed is saying are two very different things right now, Kaylee.
All right, Bloomberg's Danny Berger, thank you so much. Staying on top of those market moves, let's stay on top of the politics story as well in Europe. European finance ministers are meeting for a second day in Luxembourg with energy taking center stage. The bloc is considering ways to tackle the crisis as Russia cuts gas deliveries and the continent prepares for winter. We spoke with German Finance Minister Christian Lindner.
We have to make efforts to strengthening our common purchase on the international markets. We have to change the order of the electricity markets, but our package is not unproportionate. In fact, it is proportionate.
Bloomberg's European correspondent Maria Tadeo is joining us now from Luxembourg. Maria, you also in the last hour spoke with the French finance minister Bruno Le Maire, who told you he's not talking about common debt issuance, but he's talking of raising money with a guarantee of all states. What was your takeaway from the conversation, what the difference is between those two things?
Yeah, and Kaylee, let's just, because this is very complicated, and there's a lot of jargon in all of this, as it often happens in European discussions. If you go back to the fundamentals, the issue here is that all of these European countries agree that energy prices and bills have to go down, but they do not have the magic formula that works for all of the countries. There has been a number of things happening over the past week. You have the Nord Stream that exploded, and then you have the Germans that came up with a mega package of 200 billion euros to prop up their economies and their households. Now, that has created concerns in the euro area, with a number of countries suggesting behind the scenes that Germany has a fiscal space that other countries do not, and this could create disruptions within the union, but also be a problem for the level playing field across the euro area. And that's where the French come in. They say, we don't want to criticize the German plan. They have a right to defend their domestic economy, but we have to do this in a way that's coordinated. Now, he does not talk openly about joint debt for the time being. What he says is that Europe could come up with a mechanism that could essentially put out loans backed by the EU that could then be reset and provided to different member states. So this is incredibly complex, but going back to the fundamentals, it's the issue that a number of countries have been taken aback by the size of the German package, by the lack of communication from the Germans, but also this idea that come the winter, it cannot be every man to himself.
Okay, and so is there a sense that unity has been rediscovered then, Maria, in Luxembourg, or do they still remain very divided on the extent to which countries should be able to go it alone?
Well, and funnily enough, Anna, I can't tell you the amount of times I've heard the words unity, solidarity, we have to stay together, the sanctions are working because we've done this together, and so far this has been essentially validated by the fact that these decisions are taken unanimously. To me, it was striking today when I spoke to the German finance minister, who was in damage control, telling me there has been a misunderstanding, the package is big, but so is a problem for Germany. Everyone else is doing this, but he was very clear on this idea that I do not see how more debt will fix this problem. So this is a conversation, Anna, that I'm sure will evolve in the next few weeks, and this is not the end of it by any means.
All right, Maria, thanks very much. Maria Tadeo there reporting from the EU finance ministers meeting in Luxembourg. Now let's get back to the banks. Credit Suisse shares trading higher today, just one day after touching a record low. The Swiss lender's credit risk gauge jumped to an all-time high yesterday after the CEO, Ulrich Körner, failed to calm markets on capital levels and liquidity. Stephen Ahrens, Bloomberg's finance reporter, joins us now out of Frankfurt. So, Stephen, how serious is the danger to Credit Suisse?
Well, clearly, the market is extremely nervous. There's a lot of speculation about Credit Suisse. There's even speculation about capital, how much capital will it need to raise for a big restructuring they're planning. The CEO, as you said, he sent out a memo to reassure people. The bank is talking to people to make sure they understand it's in a solid capital position. But again, the uncertainty is really, really big, and there's a lot of uncertainty generally in the market about the macroeconomic environment. So it's a volatile and difficult situation that Credit Suisse will need to manage over the next few weeks.
Yeah, and Stephen, it's still a few weeks, as you say, until we get the details. Meanwhile, the roller coaster ride continues. Stock down substantially, as much as 12% yesterday, jumps back up 5.5% today. What's next to watch?
Yeah, exactly. I mean, it's a roller coaster. And the executives, I mean, you just said they have a new CFO who started just yesterday. He came from Deutsche Bank, and he's got, I mean, luckily, he's got good experience managing the CDS price, a volatile CDS price, because he used to be at Deutsche Bank. And so everyone's watching for something to happen, for more guidance on what could come, comfortable with the capital levels of Credit Suisse. And the question is if Credit Suisse will be forced by the market to make an announcement before they actually plan to do so at the end of the month when they present third quarter earnings. The market pressure could become so big that they will have to say something before that.
All right, Bloomberg, Steve Ahrens, thank you so much for your reporting on Credit Suisse. Another company we're watching this morning is Tesla. Cathie Wood's ARK Investment Management bought over 130,000 shares of the electric car maker after they plunged when third quarter deliveries missed expectations. It's the second time ARK has bought the dip in Tesla this year. A few other stocks are moving in pre-market trading as well, as we have Tesla up about 2.7%, and they actually are all also automakers and specifically EV makers. One of them being Rivian Automotive, which of course is another big EV maker. It, after the bell yesterday, reaffirmed its production guidance for the year, expects to make 25,000 vehicles. As a result, that stock is up 7.5% before the bell. You have another EV maker, Lucid Group, higher by more than 2% as well, and then finally Stellantis getting a bid too, up 3.6%. Matt Miller, Merry Christmas. All car stocks for you this morning.
Thank you so much. That's so kind of you. Anna, what have you gotten me?
Yes, I have you a conversation about the weak dollar. This is more for me than for you, isn't it, given travel plans? But yes, a little bit of weakness in the dollar. We'll talk about that with Kip Dukes. Is it premature? Goes hand in hand with all the risk appetite we're seeing globally today. Kip Dukes joins us from Societe Generale, Chief FX Strategist. And we'll also talk Brazilian politics, the Bolsonaro bump. Perhaps Brazilian equities are soaring after the incumbent's better than expected showing in the first round of presidential voting. Is it all about him, or is it about the tack to the middle that both contestants might make? More on that ahead. Plus, waiting for an encore after emerging from the pandemic on top, Pfizer is coming under pressure to produce its next big hit. Read more in today's Big Take story. That's on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
August jobs were right on target.
Pretty much in line with what Wall Street expected at Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, Friday on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here with Kayleigh Lyons in New York, Anna Edwards with us out of London. Now, my heart goes out to anyone who needs to refinance a mortgage in this market, especially in the UK. I don't have such emotional feelings about companies needing to refinance debt as they probably should have done it any time over the last 2 years, but this is still a problem. We're looking at refinancing debt at a cost that's more expensive than it's been in over 22 years. This chart goes back to when I was hired here at Bloomberg. We've never seen a cost to refinance this high. Priscilla Azevedo-Rocha, Bloomberg's credit reporter, joins us now to talk about what this means for the markets, what this means, Priscilla, for the broader economy, and what it means for companies.
Hi, Matt. Yes, that's right. It has become really expensive to refinance your mortgage, to refinance your bonds. It doesn't matter what type of debt you have now, it has become more expensive. So markets have changed. So that means the companies, they're going to have to rethink what they're going to do when they need to raise finance. Either come to the bond markets at more expensive prices or with higher costs, or look elsewhere for financing.
Good morning to you, Priscilla. And I suppose it's for this reason, because of this blockage that European corporates have run up against, and global corporates to some degree have run up against, that the market got quite so excited about a small pivot perhaps from the RBA. So if the whole world is looking for when are central banks going to pivot away from the laser focus on inflation to, oh yes, growth is actually also a concern. We saw a little bit of evidence of that. Is expectation of this having global relevance, though, is that premature?
It can be a bit premature when we're looking at Europe, because the European Central Bank is way behind other central banks in the hiking path. So there we have a little bit of dissonance. But when we're looking into the Fed and the US, perhaps now the discourse is that they're going to continue hiking. That's at least what economists are expecting in the market. But maybe once that can provide like a little silver lining and the attention turns back to growth.
Okay, Priscilla, so that's what's going on in kind of the macro scale. If we focus on some individual stories, the one that has captured all of our attention over the last 48 hours or so is Credit Suisse. What is going on with CDS today?
Well, CDSs today, they have eased slightly, so they're not rising. So the risk of defaulting from Credit Suisse, they're not as high as it was yesterday. There's still like, but this is in line with broader markets. So we need to understand that market sentiment today has improved slightly. There's some better news in the market. So investors are less anxious than they were yesterday. But what we've seen yesterday was a sign of concern. So investors are ready to act, and they're showing that they're watching, and they are watching Credit Suisse for the next steps.
Okay, Priscilla, thanks very much. Priscilla Azevedo-Rocha with the latest on credit markets. And for more market analysis, check out MLIV Go. That is the function on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
Policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How do Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA. Which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Underground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Ukraine, President Volodymyr Zelensky said that liberating settlements from Russian occupation is now the trend. His forces have pressed further into the eastern Donetsk region and seek gains in the south. Meanwhile, the Biden administration will announce another package of U.S. weapons within days. In the UK, Chancellor of the Exchequer Kwasi Kwarteng will try to reassure financial markets about his economic strategy. He originally planned to release his medium-term fiscal plan next month. Now Bloomberg's learned he will announce it sooner. He's been under pressure since the tax cuts he announced on September 23rd led to a sell-off in UK assets. The housing market in Manhattan is starting to cool off. Sales of co-ops and condos dropped 3.7% in the third quarter from the previous 3 months, and they were down more than 18% from a year earlier. That's according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. The median price was down more than 7% to a little more than $1.1 million. And New York Fed President John Williams says the central bank still has a ways to go when it comes to raising interest rates. Speaking in Phoenix, Williams said interest rates are not at a level that would restrict economic growth. He said he expects real GDP to be close to flat this year and grow modestly in 2023. And Matt, I guess that's a signal that the Fed is not anytime soon going to go the way of the RBA with those 25 basis point rate hikes.
Yeah, I don't think you could count on that soon. They've been incredibly vocal about it. Only a couple of Fed governors have talked about the problem of over-tightening, so it doesn't seem like something that's on their minds.
Yeah, and that's exactly the context with which I read the story, thinking about the enthusiasm that the markets have jumped on. Weak data in the US, the RBA not doing 50 but doing 25. It does seem as if investors are still really primed, really looking for those signs of a pivot. And maybe that is premature if, as William says, we're not in anywhere near restrictive or not in restrictive territory. Let us ask Kit Jukes shortly, Societe Generale's chief FX strategist. Does he think the appetite for risk assets we've seen in the past 24 hours has been premature? How much more hiking will the Fed deliver? How much do we need to reflect on the hiking we've already seen and the damage that might have done? We will talk to Kit about all those things shortly. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and meddlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind and open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.